Hello, a very good sparkling Sunday morning to all of you. Good morning. I am CA Nisha Patel, your host for this session, and I'm truly honored to stand before you on the third day of GLOPAC and wishing you all a very happy and good morning. It is my pleasure to extend a warm welcome to all of you for this wonderful session. The theme for today's session is technology and startup finance essentials from seed funding to scale. This is panel discussion where we are going to discuss about the financial aspects of startup funding strategies, financial modeling, and managing growth. Let us join a team of experts and learn from the successful startup CFOs, investors about the intricacies of financial management in a startup environment. To deliberate further on this topic, we have with us our distinguished speakers for this session. May I please take this opportunity to welcome on our stage our CCM, Mr. Mangesh Kinare, CCM of ICAI. A big round of applause for him. CA Hitesh Sachdev, who is Head of Startup Engagement, ICICI Bank. And Mr. Kamal Bansal, Managing Director, GVFL Limited. A big round of applause for all of them. To commence our session, I'm delighted to invite on the stage Mr. our CCM, Mr. Mangesh Kinare, to give the opening remarks. Thank you. And I would also request to take it forward, sir.
Good morning, friends. On this Sunday morning, I think we are having a discussion on startup. Perhaps considering what I can say, the ecosystem of startup, Sunday is supposed to be the, it's kind of in a Western scenario. It's not a right day for startup, but still, we thought that we should discuss this on Sunday. I mean, this has been scheduled today. And I'm very glad that the two panelists who are there with us, CA Hitesh Sachdev and Mr. Kamal Bansal, I welcome them on behalf of the Institute of Chartered Accountants of India. Friends, you might be enjoying the great first ever GLOPAC, which is being organized here on a different tracks and a different modes. For the benefit of the panelists, let me tell you, sir, we are running 4 tracks at a time. Plus, we have some networking sessions. Plus, we have an exhibition going on. So I would invite you also to visit different aspects of this GLOPAC. Friends, as far as this subject is concerned, we have gathered here today. The name, generally we discuss on startup, and when we discuss about startup, it is funding or entrepreneurship. And typically, it is only the starting point which we discuss. We thought this time, considering the current scenario which is going on and a lot of stories coming up regarding, startups not being that successful and not going forward so much. So we thought that this subject should not only be on funding, it should be seed funding to scaling. Now, the scaling up strategies also are very important for startups. See, it's okay. I mean, we have to, of course, understand the financial landscape, how the funding can be done, what kind of resources are there, what can be the strategies for funding. And while doing that, definitely the aspects of investors and their psychology and what is investors are expecting, what can be the exit policy for investors, these all have to be thought out. But at the same time, what investors' perspective is there, how the management of startup should be looked into, what aspect should be looked into, what can be the role of CFOs. So from the investor's perspective, what as an entrepreneur or as a financial modeling consultant, we should look into it. That is also very important. So as a chartered accountant, the institute forecasts or institutes expects that the role should not be limited only from the purpose of the funding, right? It is, we have just funded somebody and then hand holding and chalo aap aage chale jao. So that kind of a thing is not expected. As we always say, the chartered accountant is a complete business solution provider. So for startups also, in order to enter into it, right, we must first imbibe the startup psychology, the startup mentality. So what kind of, how it is to be developed, what kind of a mentoring should be done, what kind of a handholding chartered accountant can do, not only in funding, but also a regular financial modeling, a regular kind of activities which startup take up, and the growth strategies. So there is something called as a virtual CFOs world, nomenclature, which is coming up, and that is more made popular by these startups only. And that is another opportunity for chartered accountants in practice. Of course, an entrepreneurship will be discussed, but in addition to that, in addition to funding, what can be the regular mentoring, how the chartered accountants can mentor regularly, and what chartered accountants should know for the purpose of that. And that understanding that is very important. From that perspective, the subject or the topic name which we have discussed and which you have decided is a seed funding to scaling. So right from sowing this seeds, one can say, in terms of tree, till the tree grows up, it is our responsibility, and what kind of a mentorship we can do, that we are going to discuss today. I again welcome the two panelists who have come here, Hitesh bhai and Kamal ji, and we'll be having a discussion. We'll be having some questions which we will pose, and later on we will throw this session open for the audience, for some 15-20 minutes. So with this, I welcome the panelists as well as the my members and the participants and delegates for this session. And I hope this session would add the entire, what I can say, that change the entire outlook of chartered accountants of looking into the business consultants rather than only the funding consultants. Thank you very much. We will start the panel discussion immediately. Thank you. So, Hitesh ji and Kamal ji, just as I said, the objective of this session is not only from the funding point of view. We don't want to, because a lot of things have been said, many seminars and many programs you have discussed about the funding strategies per se. Of course, we'll discuss that also. I would like to, first of all, ask you to give your first initial remarks for 5 minutes or so, each one of you.
Good morning, everyone. Thank you, ICICI, for inviting me here. As such, we are GVFL based out of Ahmedabad. So we are fortunate to be based of Ahmedabad. And we are directly in touch with the ICICI team, Ahmedabad, who have, I think, have proposed my name to participate in the seminar. GVFL is basically known as Gujarat Venture Finance. We are a 30-year-old VC firm, one of the oldest VC firm in the country, and primarily focus in Gujarat, also outside Gujarat, invested in tech startups. So we have overall corpus around 1,000 crore, AUM is 1,000 crore. And we have invested in more than 100 companies in our life cycle of 3 decades. Currently, we are investing out of our early stage fund, where ticket size, we start with $1 million and we can go up to $3 billion. So that's our focus, mainly in the tech startups. So just for introduction.
Yeah, of course.
Hi, good morning, everyone. First of all, let me congratulate the entire team behind organizing this GloPEC conference. I think to organize it at such a scale requires a lot of hard work and dedication, and it is stepped up really well. So congratulations to the entire team. I manage startup engagements and investments at ICICI Bank. So primarily, we again, like my colleague Kamal ji, is investing in tech startups. Similarly, we also invest into tech startups. We invest generally at pre-series A or series A kind of stage. Now our investment check size is ranging from $1 million to $5-7 million check size. Every year we do around 5 to 6 investments, and primary focus is on emerging technologies. And idea is how do we use those technologies to solve some of our problems, in financial services. Apart from that, I also manage a digital infra company, which is where, we have 18 banks which have come together and created this entity. And, we do a lot of innovation and experimentation on emerging technologies on digital side in that entity. Yeah. And I mean, let's make this session more interactive. So please feel free to ask any questions, while we will debate and discuss. But, questions from the audiences are also welcome.
Thank you. Thank you, Hitesh. Thank you, Kamalji. My first question will be for both of you. Then I'll, segregate it. Because as I said in the beginning, right, we are thinking about, seed funding to scalability. Now, of course, let's begin with funding. Now, when we consider funding, I mean, how do you look into any project, or what I can say is how a chartered accountant should present the project and what chartered accountant should think about the project first, whether and how one should go ahead about the funding strategies. If you can start on.
Sure. So as investor, I think, let me tell you our side of the story so that you can relate it better. So as investor, what do we look out for when we make a decision to invest, right? I think the first and foremost critical aspect of decision making is the founder and the founding team. Most of the time, it starts with an idea, or even if there is a product or a service or a platform which is developed, it is not at a stage where it is a scaled up, kind of a product or a service. So the first and foremost aspect of considering an investment is the founder and founding team's capability in terms of pursuing that idea and, take it to a logical conclusion, right? So, and when we look out for founder, I think the characteristics, right, which we like is that how passionate a founder is about solving a particular problem. And also, is he confused or clear, right? I mean, is he trying to solve multiple things or trying to solve a one particular, problem? Whether a founder is a team player or is a solo player, and there are many intelligent people, but they are more solo players, but they're not able to take along team with them, and they're not able to create organization, right? So the other aspect is the background. I mean, so if a founder is pursuing an idea and trying to solve that idea in a domain which is known to a founder, it's again a positive thing for us, because that gives a lot of comfort that founder understands what is he getting into. Apart from that, whether founder is too greedy, right? I mean, so generally we see if there are 2-3 co-founders and a team, is founder willing to share that pie of wealth with the other co-founders? Is the shareholding if not equally distributed among the co-founders, but there's a meaningful shareholding with the other co-founders as well? Then we do a lot of reference check about founder. If a founder used to work somewhere, we ask their ex-employer, what was the feedback, how was he during the work tenure, right? I mean, a lot of interpersonal skills we try to map, and I think the most important characteristics probably we look out for a founder is that one is passionate about solving a problem or not. That's the most critical aspect of it. Otherwise, in a startup life, you face multiple problems while on this journey, and many times people give up, right? So, but if you're passionate about solving that problem, you'll take it in your stride and continue working on that journey, right? So, and then the second aspect which comes is about the team. And team means, are the, people in the team of similar kind, or are people are coming with different skill sets? I mean, is it a team which can together, completes, in terms of skill sets which are required to solve that problem? So most of the time, initially, obviously, there are not very large teams, but teams, and then who are the people who are backing them, right? So many times at early stage startups have advisors. So what is the reputation of those advisors? Are they relevant for the problem they are solving for? Apart from that, whatever seed capital people have raised, whether founders have put in their own capital. Most of the time, if if younger founders are there, they may not have enough capital to put in, but that's fine. If we don't actually want, that founders should put in capital, and, that's not a major criteria. But if a founder has made money in life, he's a, a late stage founder, then obviously there is an expectation that he should put some capital into the business, so that it also, kind of gives us the comfort that there is a skin in the game, and there is a, equally, he's also equally kind of, passionate. It's not just building the, kind of enterprise on investors' money, right? Uh, so these are the typical things which we look at, from the founders and the team and the advisors perspective. From the perspective of the, the problem which a founder is trying to solve, I think for us, the most important part is that whether founder understands the problem or not. We are not looking at solution. Solution is a 10% part of it. I think the 90% part of it is the understanding of the problem. So one important aspect is how well the founders understood the problem, and whether it is large enough problem to solve. If it is just a Me Too idea, there is a very lesser chance of creating a scalable enterprise, right? So whether the problem which one is trying to solve can impact, millions of customers, can it create a large impact? That's what we look out for. And then the third part, which, boils down to, once we have comfort that, yeah, the problem is large enough to solve for, then the third part is about the execution capabilities, right? Many people are good storytellers, right? But they may not be good executors. So we also feel that idea is, 10-20% of the overall, kind of the startup journey. I think 70-80% is all about execution. So whether, the team which you are kind of engaging with is, capable enough to execute an idea, or they have shown early signs of executing it, right? And obviously the other characteristics like, frugal way of operating, right? Whether they are able to, gather resources, at a cheaper cost. So like many times we meet founders who are operating from small offices, or, they've kind of borrowed office from their, relatives or their friends, and they are not paying any rent for it, or they have hired interns, from the colleges or institutes, so that they don't have to pay for employees, right? So these are all, things which are part of startup life, and it's good, one should try and use this kind of, resources which are available at the early stage, while you are building your enterprise. So these are some of the factors we look at it when any founder or founding team comes to us for, fundraising at early stage. And yeah, I think I can go on and go on, but I think I'll.
Yeah, Kamalji, whether you can add up anything, and perhaps I can just think came to my mind, and that question also I'll ask. Do you really look into that? It's a unique idea only, or there's something idea which is also vogue in the market, but still somebody wants to add up to that? Or do you evaluate that also?
Definitely, as such, Hitesh has covered, I think, a lot of ground in terms of comprehensively. He has covered team, he has covered market, fund requirement, resources, everything. But as far as idea is concerned, I think that is the most important. Uniqueness naturally has to be there, because if it is a very copybook idea, then naturally it's not going to sustain. But at the same time, only idea is not material. Idea is important, but at the same time, important is execution. How he is going to execute the idea, about the idea or the problem he is going to solve, whether it is a big enough, number one. Number two, whether he has the capability to solve that issue. Because idea may be unique, but whether he has a team to give that kind of unique solution. As we know, in word, there's nothing unique. Every solution, every idea is, I think, prevalent, and people are trying to working on all idea. People are working, but it is a quick execution what he can deliver, and whether he can deliver that execution within the resources, what kind of resource requirement he's looking at, whether he can raise that resources. So those are supplemental things we look at, not only idea, but also the execution skills. Yeah.
Again, elaborate on the uniqueness part of it,
Yes.
right? So I think there are three factors or four factors probably we kind of look at it, right? So one is that what is the scale of innovation, or what is the level of innovation, right? Are you kind of introducing a feature or a product which is just, slightly better than the existing product, or it is 100x better than an existing product. What is the scale of improvement, right? I mean, if it is an existing product, if you do slight improvement in one or two features, that may not be exciting. But if on an existing product, if you improve it by 100x, right? I mean, then it becomes a very different kind of a game. To give you an example, right? Messaging used to exist before WhatsApp came in, right? WhatsApp changed the way we interact, we communicate, very on a different scale. So what is the level at which the innovation one is planning for, right? I mean, today, when we talk about, let's say, SpaceX, right? We're talking of reusability of the same rockets, right? I mean, so that's an innovation at 100x. I mean, the kind of benefits it will bring in would be of a different order and a different scale. So electric cars, everybody, right from Mercedes to Toyotas of the world, the best car manufacturers in the world. I think somebody could crack electric car was, Tesla. I mean, and reason is the product is 100x superior than anybody would have launched it, right? It may be an existing idea, but existing product, but are you able to improve it at a significantly different level of innovative scale, right? I mean, that's one. Second is that are people, आपको अपना आइडिया जाके लोगों को बेचना पड़ रहा है क्या, या are you able to, or people are kind of selling that idea, or people are bragging about it, right? I mean, आप जैसे कोई प्रोडक्ट यूज करते हो, आप लोगों को बताते हो जाके कि अरे आपने यूज किया क्या, have you used this product, this is an excellent product. I mean, so and people feel pride कि अरे मैंने ये प्रॉब्लम देखो ऐसे सॉल्व कर लिया by using this product. Okay, so is there a bragging value in that idea? Then आपको marketing dollars खर्चा करने की जरूरत नहीं है. Then you don't have to spend marketing. People market your idea. When ChatGPT was launched, everybody started asking each other, अरे आपने ChatGPT use किया क्या, आपने use किया क्या? So it had a bragging effect. And bragging effect, I don't think ChatGPT went and advertised. कहीं पे hoarding लगा है या कोई newspaper में advertisement किया. They didn't do anything of this sorts, right? I mean, but they could garner largest set of customers in the shortest span of time because it had a bragging effect, right? I mean,
Yeah.
Third aspect is about आप problem solve कर रहे हो, but that the way you're solving that problem, right? Is bringing humongous incremental benefit to a customer. To give you an example, अगर आपको ticket book, you will go to Indigo, or you will go to Indian Airlines or Akasa or whatever websites are there, right? But how many of you are booking tickets through those websites? वो websites पे ticket बेचते ही है ना सारे airlines. How many of you book tickets on those platforms? No one. Very few maybe, right? I mean, because while you book tickets on Make My Trip or Go IBO or Clear Trip or whatever platforms, right? I mean, you have a very different kind of experience and you get multiple options, and then your the satisfaction level in terms of हाँ मैंने सब देख लिया, यहाँ पे ये cheapest ticket है, this is the best option, right? I mean, and then you go for it, right? So how are you solving that problem? It may be an existing method, there is an existing method which is available to book a ticket, right? Similarly, IRCTC, आप जाके आप कभी ऐसा सोचोगे क्या कि मैं ऑनलाइन टिकट बुक नहीं करूंगा ट्रेन का, रेलवे की खिड़की पे जाके खड़ा रहूंगा? I mean, there are multiple ways to think about it, right? And see that similar problem getting solved, but people would also differentiate, in those platforms and those services, right? Some of the things probably can bring about uniqueness.
Kamalji, I'll pose you one question. See, startup, they start working and all, you are funding them. So how do you support and mentor your portfolio, companies in India, especially in terms of strategic guidance, operational assistance, or network expansions? I mean, do you support, or what kind of aspects you think about when you support?
Yes, such VC are supposed to be more than, it's supposed to be smart money. So money they can raise from the angel investor, their family and friends. At a certain level, that money is important. But beyond that, that money in terms of quantum as well as in terms of value of money is greatly enhanced. Once it is given by the VC fund or the private equity funds. So they are supposed to handle the companies. They are supposed to work very closely with the company, understand the business plans. Because once entrepreneur is there, he has an idea in mind. He draws up a business plan. So that business plan may be realistic, may be very optimistic, or maybe pessimistic. So that's where we get involved into evaluation, or starting from the evaluation of the business plan, evaluating the assumptions, what kind of assumption he is making in terms of market size, pricing, growth. So all those things we evaluate, and we work very closely in terms of ongoing. Once we make investment, then our role becomes in terms of interacting with them on regular basis. Our team basically keeps in touch. We see their performance in terms of hiring, what kind of hiring they are able to make, whether they are getting right people, what kind of traction, what kind of market they are tracking. So in terms of valuation, our role is, say, we don't want to interfere also into day-to-day things. In that case, if we get involved in day-to-day things, they can always put the blame on us. So there is a very thin line where our role is there as a watchman. We are more like a watchman. We are more like participating in the board level in the broad strategic decisions. At the same time, we keep on lookout for valuation in terms of next round of fundraising, in terms of introducing, say, giving references for the customers, for the big, say, corporations from our portfolio companies. So that's where, with our experience for 20, 30 years, we have a huge portfolio of existing portfolio companies, existing founders. Plus, we evaluate, say, thousands of proposals every year. So as an investor, we keep track of the entire ecosystem and see where we can get them connected in terms of marketing, in terms of getting the right people and growing. And at the same time, I think next round of another most valuation part is getting them next round of funding, connecting them with the investors. As a VC fund, so since we are part of the ecosystem, we connect them people like ICICI Bank or many investors. In terms of nowadays, what is happening, most of the investments are being done on the co-investment basis. Most of the deals here now, they are at least 4 to 5 investors involved. No company is getting funding from a single investor. So that is a comfort level. That is being a presence in the industry for many decades. That we have that kind of relationship where the chances of survival, chances of raising next round of funding becomes very easy. So that is a valuation we do, but day to day as such, we don't get involved in day to day. But broad strategic level, definitely it's our job. It's our job to understand the business, see whatever value we can add in terms of whether for right hiring, right marketing, right strategies, and moreover, right spending. So what kind of spending they are making, whether they are making right spend, whether whatever say their money they're spending on advertising, marketing, whether it is generating that kind of results. So we are more like you can say, watchmen in terms of their spending, in terms of their right path they are taking, and then we have to make them on the right track. So we have to play the role as a VC, as an investor, because we're more like a partner. We can't just sit idle and see and just pray to the God that startup will do well. So as a mentor, we have to play that kind of very active role.
Yeah, because why I ask question is because there's a normal worry in the mind of people that there will be a lot of interference. They try to even test or check the funding agencies also who will be mentors or will not interfere. I mean, your take on that, Hitesh?
So there are two kind of investors, right? So one kind of investor, they are like investors who are like they keep spraying money on various startups, and then they, after spraying the money, they pray to God that my founder will do well. So that's called spray and pray model. So so those kind of investors, they don't even bother to call the founders what they are doing, how they are doing. Once in a while there is a board meeting, people will turn up and have kind of nice coffee and they will disappear. But second kind of investors, right, which are more active investors who participate, who like to participate, So I think the fundamental, the aspect here is that founders should be smart enough to use their investors as resource. How can I use my investor as resource? All our portfolio companies, founders, they keep giving us a lot of work. I mean, probably they look at us as like we are partners in their business. And when they start looking at us like partners, there are certain set of problems which they feel that they don't have enough resources. They actually, pass it on to us. So, and every founder has a different set of problems, which probably we end up helping them for. So many times what happens, as startups, they are not able to attract talent. So let's say if you want to hire a good talent, why would a good talent come and join you? You're just starting, right? Why would somebody leave an established job and come and join you? So there needs to be a lot of convincing which is required to an employee. You have to sell your startup to an employee that you join me, you have a brighter future here, and we are doing some extraordinary work. So most of the times we end up taking interviews of those, employees, and we tell them that we are backing this founder. He's a great founder. We believe in this idea. This will become a really large enterprise. And we end up interviewing, we end up identifying talent, and we end up, helping, founder to get the resources. The second aspect is about, the product, right? So the challenge lies when a investor doesn't understand about the product and he starts giving advice about the product, right? So that's where founder starts feeling that there is a lot of interference. If someone doesn't understand about the domain and he starts giving you gnan, the founder, it automatically feels, kind of that, why do I listen to someone who doesn't understand what, kind of work we are doing? So I think there is a very, kind of a line which needs to be drawn, right? Between, one should not, as an investor, should get into an exuberance mode that, I want to help founder, and then become a burden on the founder, right? There is a fine balance one needs to create, right? And many times, founders are lonely. Let me tell you, as a founder, it's a very lonely journey because many times you want to tell your problems. Whom do you tell your problems? If you go and tell your problems to people, they will start judging you. Problem is, people will start judging you. ये founder है, इतना भी इसको नहीं आता है, or he's thinking like that. So judgment, people start judging, and that's where, as investors, sometimes we also play a role of being a sounding board. That boss, we are not going to judge you. Anyway, we have judged you and we have put in money. Ab jo hona hai hoga, open up and tell us what are you thinking about, right? This thing. So that's where again, so I think as investors, you have to play multiple roles and multiple hats you have to wear at different stages, right? But the relationship, between, I think it's a kind of a marriage. Let me tell you, it's a kind of a marriage, though it's a contractual marriage for a defined timeline till the time investor exits, but it's a kind of a marriage. So one has to create fine balances while the way we created our home, right? The same kind of partnership we have to create with our founding teams. At times you have to, manage them. At times you have to give them freedom. At times you have to help them, so I think they are all mix and match, and a lot of interpersonal skills, come into play. But I think first one principle, if you establish, with the founders, I think, the broad principles you are able to establish with your founders, that one is, all of us are working for the good of the company. So if the baseline is that founder is also working for the betterment of the company, investor is also working for the betterment of the company. So there are no personal ego. If my view is better, please accept my view. If your view is better, I will accept your view. So when we debate, when we discuss, underlying theme is what is good for the company. Even if as an investor, if I tell things which are not, in line or alignment with the, benefit of the company, founder has all right not to listen to me, right? So I think that's one underlying principle. And if you go with this underlying principle, a lot of things get resolved. And the second aspect is trust, right? In any relationship, right? You know, to create that mutual trust. If you're able to create those, that trust relationship with your founders, I think people may not feel that, even if you are trying to advise them, guide them, people may not feel that you are interfering. Yeah.
Kamalji, again, coming to you, what are the main challenges or risks that you face or anticipate as a VC partner in India or a funding partner in India, such as regulatory, market volatility, and what kind of a main challenges or risks you face or evaluate?
Yeah, say as there are 4 to 5 points of the business about the pricing, product, market, and the funding. So they are all factors which are important for the success of the business. So that's where this factor lies in all these issues. important, I think main risk that we have faced risk in the terms of team also, in the promoter also. Sometimes there is a team among the promoter, there is a dispute among the promoters. So we have to keep track if there is some kind of misunderstanding, how well they gel, whether they are thinking in the right direction, whether their thinking is in sync, are there any disputes? So promoter risk is one of the risk in terms of whether he is losing interest, whether he is full-time dedicated, or what is his interest, whether he is doing it only for the purpose of, because it has become a fashion to start the business, or whether he's looking for the long term. What is long term vision? Because it's a journey of 10 to 20 years. It's not that you can create a good enterprise within 3 to 5 years. So first and foremost is the promoter risk. To judge a promoter rightly and the team in terms of their chemistry, their execution capability, that is one risk. Second risk, what I see is mostly is the scalability and the market size. Many enterprises, they look at the problem, they understand there is a big problem, but this is problem exactly is not there. Or the solution that they're offering is not that incremental, is not that attractive, or people are not willing to pay that kind of money for that solution or that service. So in that case, all assumptions can go wrong. Whatever assumptions we make in terms of reaching the scale, I think that is the most important aspect I've seen in my career of 20 years, that no company is able to achieve the projection what they've made. Something is expected to go wrong. Whatever conservative we make it, in terms of whether it is pricing, in terms of customers, how customer they will acquire the customer, how they will grow the customer base, or the profitability. Something will definitely go wrong. So that becomes a major risk in terms of ultimately end objectives are achieving the financial success. Product may be good, they may be good technocrat, but unless until it has got a market, customers are willing to pay for the product, then at the end of the day, it's of no use. After 3 to 5 years, it should be able to reflect in the balance sheet that what numbers you are giving. And unless until they're able to scale up, in first initial 1 or 2 years, naturally getting the next round of funding is not going to be easy. And looking at the funding meter which is there, now the VCs are also, next round of investors also looking at a very minute lens, whether we should invest in the businesses which are not scalable, which have not grown in last 2 to 3 years. Last 2 to 3 years, a lot of digital businesses have grown because of the opportunity which was provided by the corona. But now that scenario is not there. So there is a huge risk in terms of companies which are not able to raise next round of funding. Even in case of unicorns, so many of them are loss-making. So loss-making business, as such, as a CA, you might be wondering that how the VCs are funding the businesses which are negative. Perpetually for last 3 years, 5 years, they have been running into losses. But VC generally take that risk because ultimately we are funding to meet that loss. So our money is going to meet all the operational expenses, all the losses what the company is going to make. But at the same time, after 2 or 3 years, whether the company is going to raise the money, whether the company is able to grow fast enough. So those are challenges. Sometimes it is the mentality of the promoter. So we have to deal with both kind of founders. Sometimes founders are very conservative, that they don't spend money. Especially we see in the Gujarat that after raising even 5 to 6 crore, they are able to manage within 2 to 3 years. They continue their operation for at least 3 years within 5 crore, which ultimately doesn't lead to anything because many of them are not able to raise money. The growth is very slow. So that becomes a critical risk factor for us.
Yeah.
So these are many things, but briefly, I think the scalability becomes the risk. It may be due to the product, it may be due to the promoters, or promoter lose interest if the scalability is not there and they are not able to raise funding. So these are a basic risk factor which we have to consider.
Just corollary to this, Hitesh, I'll ask you now how the startups can prepare themselves for the next stages of funding, such as Series A, B, C, etc. What are the expectations of investors in that regard? And whether an additional investor can be looked into from that perspective. How do you see that stage? And what kind of a scalability investors look into for the next stage of funding?
So I think every stage of funding, there are milestones, right? What you define. So as a founder, when someone raises seed capital, milestone is that product market fit achievement, PMF, that I will create a product, it would be acceptable in the market. But, so that's stage number 1. Then the stage number 2, how do I kind of market that product, right? Create a scale. Stage number 3 can be, kind of expanding from one state to, let's say, a few more states, Another stage could be expanding to, let's say, international markets, right? So there are all milestones, where you keep achieving those milestones and then you create a track record, right? So if as a founder, if I have told my investors that with this much capital, I will achieve so much, and if every time you are able to demonstrate that, right, it creates your own track record. Uh, that whatever you are committing, you are actually achieving it. I mean, whether you are, see, making loss, and it's a lot of, people have a lot of misconception every time. I think like what Kamalji said, right? That loss making company hai, kyun paisa de rahe ho aap? Why are you funding loss making companies? After raising, billions of dollars, still you're making losses, right? I mean, तो पर्सपेक्टिव बनाना पड़ेगा ना. अगर आप एक फैक्ट्री लगा रहे हो, तो you will put plant, machinery, land, you will deploy all those things, right? I mean, tech companies में वो सब नहीं होता. You don't need a plant, you don't need a machinery and those kind of stuff, right? There the core investment is your platform, your product, your market which you are creating. So one has to think in a very different kind of context, and also time factor. Whether something can be created over a period of 25, 30 years, or something can be created in a period of 10 years, right? I mean, and generally, these businesses have tendency of getting into monopoly, right? Kind of monopoly once they scale up. So, so for example, if I ask anyone, what are the options for ordering food? How do you order food? Any third name? Does any third name come to your mind? No. But I mean, largely, how do you book a cab? Any third name? So I'm saying these are businesses which creates monopolistic situations. I mean, there is no way you can, not use them. They are part of your daily lives. So at every stage, if so coming back to my, the point to answer the question, that every time when a promoter goes for fundraise, right? I mean, one needs to have an absolute clarity that what am I gonna achieve with this fundraise? Is it just that I want to create a benchmark of a valuation so that I can tell to my employees or my peers that I have achieved so much of valuation? Or with this fundraise, I'm gonna kind of achieve, it can be metrics, can be number of customers, metrics can be revenue, metrics can be in terms of engagements on the platform, whatever, right? I mean, but you need to clearly define that metrics, and that metrics has to be something which either propels you to the next hyper level of growth. So investors are always looking out. So we are okay to fund losses. We don't fear, I mean, if there are loss making balance sheets, right? I mean, but whatever capital you are deploying, is it creating hyper level growth, right? I mean, so today, if you are acquiring a customer at 1,000 rupee, after 2 years, are you acquiring customer at 100 rupees? Initially you started acquiring customer at 1,000 rupees. Now you are acquiring customer at 100 rupees. So is your cost of acquiring customer gone down? I mean, so that is what we look out for, right? So these are different sets of metrics which becomes important at different stages. And at every stage, I think promoter, needs to be very clear that what is the, end outcome which I'll deliver by, raising this capital, and one has to articulate that very clearly. And fundraising has to be always done when you don't need money. Okay. So when you need money, you are desperate. Your body language shows up. Then you're not a better negotiator. Okay. I think ideally, if you feel that I will need money next year, start preparing it for this year, so that whenever you go to an investor, and then you have a track record to show. So while investors you engage, they will also measure you. That in January I met you and you told me that by March or by April you will achieve this number. And now again I am meeting you in April. Have you achieved that number? Right. So then, and if you achieve that number, it gets a positive kind of, impression in the mind of an investor that this promoter, whatever he commits, he achieves that. So I think depending on the different stages, one needs to kind of prepare, whether you are raising for growth, whether you are, raising for, a tech, expansion, what is it that you're raising for? And then put metrics, for those fundraisers very clearly and communicate them to your potential investors.
Now, I mean, I'm throwing it open for public, I mean, audience for questions. But before that, last question I'll ask from my side. Of course, there's one more question which has come. I'll ask later, which is very basic and fundamental question. I'll ask that later. But typically, I mean, just very briefly, you can answer. Typically, what are the stages? How much typical stages you look into? For say for the purpose of first founding, start of the business, then taking the to the next level. Number of years, in terms of number of years. I know it's very difficult, but what is the ballpark answer for it? So, say first 2-3 years and 3 years, or what kind of that thing? And how many stages? You think?
So there is a complete life cycle starting from the seed stage, idea stage. So idea stage to say in terms of coming out with a minimum viable product or proof of concept, it may take say 6 months to 1.5 years. So roughly 1.5 year, 1 year to 1.5 year is the stage, which is the basic stage. You raise initial 50 lakhs to 1 crore from your family and friends or some government grants. So that is the seed stage. Then comes the pre-series A. Pre-series A means where you have already started marketing the product, you have acquired initial customers. So in each stage, there's a funding requirement. Each stage, you have to be very careful about the valuation. Valuation becomes very important in terms of each stage. Initially, suppose when you're raising, say, up to 1 to 5 crore, that is seed stage or early stage, very early stage, early revenue stage. Dilution is important that, okay, you don't end up diluting more and you don't end up raising more money than what you require. So there's also very science, very art in terms of, okay, you raise up to 3 to 4 crore, you dilute only 5 to 10%, and then go to the next stage. Next stage becomes the pre-series A. So then series A, series B. Pre-series A means you are raising money for reaching out to bigger number of customers, building out your team. Then the fund requirement may be anywhere between say 5 to 25 crore. That becomes the pre-series A. It may take another say 1.5 to 2 years. Say roughly say up to 3 years when you become the pre-series A candidate. So during that 1.5 to 3 years, you raise next round of funding, end up diluting another 10%, end up diluting for the ESOP. So that is where the structuring happens that, okay, before series A, you should have diluted, say, not more than 20% of the company. So there are important things to be considered in terms of how much fund to be raised, timeline for fundraising, what kind of dilution you make. Say if you take 3 to 5 years, even for the pre-series A, then it means this company is not going good enough and the product is not good enough. So maybe 2 to hand, but now as such, if you take the example of Zepto, company happen to raise series A money within say 18 months, 12 to 18 months also. So there is no perfect time, but depending on the what kind of product you are, if it is a very hot product, you have something unique which captures customer very fast, then possibly you can reach pre-series A within 12 to 18 months also. But if it is slow, depending on how much money you have raised, it may take up to 2.5 years. But I think beyond 24 to 36 months, it becomes very lengthy. So you should be able to pre-series A within 24 months or maximum 30 months. And then you go to series A. Series A means you are raising a bigger round, 5 million above, where the company is now raising money for a scaling up. Scaling up means you are spending money on the marketing, you are spending money on the channel partner, you are spending money on the team, your sales team, your promotion budget. You are promoting your things very aggressively with a marketing budget. Because after say pre-series A, you are going to spend money, product is already established, it is well accepted, you have done all test marketing, then it's a growth phase. Pre-series A means growth stage. You raise money for another 12 to 18 months. Because here, everything, your timeline is linked to the how much funding you are raising. And there is a runway for that funding. That runway may be 12 months, it may be 18 months. Or it may, you also spend up faster. You may end up spending faster within 6 months. So we have seen a case where the company is spent 400 crore within a period of 6 months. And so that was the case when the investor put so much pressure on the company to scale up. They end up spending 50 crore, end up making loss of 50 crore per month in the D2C business, in the direct marketing business. So that should not happen that, okay, for the say want to scale up, you end up spending too fast that, okay, you are not able to raise next round of funding. So series A means after 24 months, series A, then another 12 to 18 months, series B, or they are bridge rounds. So that's how the life cycle goes.
That's what in these stages, how you evaluate the scalability? That's my last question, and then I will go to the public.
I mean, just, kind of building upon that point, which Kamal ji mentioned.
Because our main topic itself is seed finance to scalability.
Yeah. So I think two other aspects which are very important in the journey, startup journey, is that your ability, to pivot. One is to pivot many times. So people start with an idea and they raise capital also, but on the journey they realize that this is not working, right? I mean, so at that juncture, there are two options which are available. One option is that, you know, let me close down this, because it's not working. It's not going anywhere, which is a good option. Life may, if you fail fast and, do something else, in life. So I think everybody makes mistakes in life and we should kind of, not fear, making mistakes, but you should make mistakes quickly so that you are alive for making other mistakes, right? I mean, so don't spend your entire life in making one or two mistakes, right? You have to make many more mistakes.
Should realize
So,
that
yeah.
quickly.
So failing fast. One needs to fail fast. If it is not going anywhere, you realized quickly. Self-awareness is very important. And then you fail fast, it's okay. It's not a stigma. It's not a taboo. Failed entrepreneurs are more valuable. I will at any point in time recruit a failed entrepreneur in my team. Failing fast is the most, if you're not, I mean, I'm not saying you should create a recipe for failure, but yeah, in the journey, if you fail, I mean, it's okay, but don't, spend too much time realizing that. Second aspect is pivot, so let me give an example, like, Fasus, everybody would have tried at some point in time, you know, they went on this journey, they designed these wraps and all those food products. Uh, they realized that this is not going anywhere, right? I mean, so what do we do? I mean, one very important insight they got from their business was that most of their customers, were ordering food online. And that, kind of made them to kind of create a pivot wherein they launched multiple cloud kitchens and multiple brands. And today, Rebel Foods, it's one of the largest cloud kitchen company, in the country, right? So, you need to kind of learn from those failures quickly and then, pivot, fast, right? I mean, coming to the, the point of every stage, right, what one needs to be cognizant of and one needs to prepare. I think, you know, uh, the way you look at, as an entrepreneur, the company has to be different at all stages. So, अगर आप 5 करोड़ की कंपनी चला रहे हो और एक 100 करोड़ की कंपनी चला रहे हो और एक 500 करोड़ की कंपनी चला रहे हो, आप अगर वैसा ही सोचते हो जब आप 5 करोड़ की कंपनी चला रहे हो, वो 500 करोड़ पे people will get tired, you will get tired, and it is a recipe for collapse, right? I mean, disaster. So every stage, founder also needs to change. आपको रियलाइज नहीं होता है, बट हर एक स्टेज पे फाउंडर को भी चेंज होना पड़ता है कि मोस्ट ऑफ द टाइम अर्ली स्टेज में फाउंडर सब कुछ करता है, बट उसके बाद अगर वो सब कुछ करता रहेगा, then the scale may not happen. So I think at every stage when you kind of start, scaling up, you need to ensure that you have enough and more competent team which is taking care of those functions. And as a founder, you are spending a lot of time on the crucial aspects of, like, defining the, the future roadmap, engaging with the, key stakeholders. आज अगर इन्वेस्टर के पास एम्प्लॉय जाएगा कोई, they will not, be, kind of, they will not give funding basis the employees. They want to spend time with the founder. They want to understand the founder's mindset. So at every stage, founder also needs to realize that what is my role, and then keep, changing at every stage of the company. See, I mean, as far as, uh, you are ethical and you are able to demonstrate, right? I mean, the governance part of it in the business, it is a big plus. I mean, uh, a premium which is being paid to a well-governed company would be far more higher. So, as an entrepreneur, one also needs to create a lot of ethical, kind of practices in an organization, right? I mean, many times people kind of, misinterpret shortcuts as innovation. Shortcuts are not innovation. right? I mean, so, and innovation one should do in product and not in accounting. Okay. So all of chartered accountant friends, my advice is that you should also, when you deal with the startup entrepreneurs, please advise them rightly, and uh, that aspect, founders, if you're not doing well, if you go and tell your investors, they will put more money, they'll back you. But moment somebody gets a feeling that, there is something else cooking up, people will not back you. So that's another aspect, and this is not, it is irrespective of the pitch. I mean, from the day one has to be kind of, be transparent and ethical, right? I mean, the other aspect is that, communication. Uh, how do you communicate to your investors, to your employees, to your customers, right? Every stage, the level of communication differs. It cannot be the same level of communication. The early stage, probably, there are small teams, so you may not feel a need to communicate because everybody is aware about what you are doing. छोटा team है, 10, 15, 20 लोग हैं, सब साथ में बैठते हैं. Everybody knows what, company is doing, company is going for. But जैसे जैसे company बड़ी हो जाती है, I think you should keep telling your employees which direction we are going, what is our objective, how well placed we are to achieve those objectives, right? I mean, तो हर एक stage पे ना ये, I think the founder's responsibility to keep evolving with every stage, and we have always seen that, solo founders or a mindset where people have that I will do everything is a big no for us, right? I mean, we always want people who are more inclusive in their approach and who are team players, right? Those are the people we have seen are able to create large enterprises. So at every stage, we are able to map, founders, that whether they are able to attract good talent, whether people are willing to work with that founder. See, many times it is not about the organization; it is also about individual. So those are the few things I think.
You want to have any question? Yeah, you can. Mike hai? Yeah. We'll take. We'll come. First, he has raised the hand. I'll come to now. Audience only.
Yeah, I just wanted to know, like, we also trying to, like, we invest into some startups through some, Let's Venture or some other Home Security and others. A small amount of 5 lakh or like each venture, we are putting money. At the same time, we are also working on our own startups. So 2, 3 startups, we are already running each partner, taking it of each one. So we just want to know, like, whether you also evaluate the business plans and strategies which are going to be pursued by the founder, because that's a confidential thing. Otherwise, I don't want to share my business plan, how I am going to grow, and like what are the things I am targeting, and what would going to be my strategy for acquiring the customers and expanding my base. Uh, I have seen like a lot of founders are afraid of their idea being stolen.
So
Confidentially, sir.
see, it's like
Yeah. If the founder is not willing to share that kind of information, so naturally then will not be comfortable, because so whatever he has in mind, he has to consider the investor as a partner. We are not his competitor. Naturally, in early stage, he is not sure whether he is going to get the funding or his idea is getting stolen. But VCs are not in the business of
yes, exactly.
trespassing or getting one idea and then sharing with another. And more than idea, it's the execution. So
Exactly.
ultimately, he may have something in mind. Whether he is able to execute, his execution will always be different from the execution by another person. So that way, idea is not a monopoly, and I think he should be open to, and you should also advise that he should be very transparent, because right at one stage he's not willing to share his strategy, and next stage he's not be willing to share his financial, or so that kind of mindset will not work.
Well, beside this, one more thing would be like whether you would like to my ideal question was like whether you analyze the business plan and strategy, so that if something is making you find something like it might not work based on your experience, so you
Definitely.
suggest you should change this strategy or plan.
Yeah, so analysis means whether whatever he is proposing is viable, feasible, and whether it is financially, you can say, fundable. So those things we have to evaluate. So he is assuming something, whether it is achievable or not, given experience of evaluating so many businesses, whether it is a, say, there are certain thumb rules. As a direct to consumer business, there are certain thumb rules in terms of marketing, customer acquisition cost. So those things, similarly in the B2B. So we go by those thumb rules, and also with the individual businesses. So that gives us good insight and knowledge how to evaluate. So definitely we have to do that.
Yeah, next.
Not take long.
My
because,
question is, sir, my question is this, that what is your exit plan in case of VC?
say normally as a VC, we generally, our main role is to get next round of investors or to sell the company. So we don't aim for the IPO because we are early stage investor. Life cycle of the company is very long. We are there with the company for maximum 5 to 7 years. So our exit plan is basically next round of investors. That has been the case. Earlier, there used to be promoter buyback or strategic sale. Strategic sale is also one because early startups, if they are attractive, they are delivering some solution which is okay, good for some big company. It fits into the business plan of a bigger funded startup. And normally big startups are also acquiring smaller startups. And even the corporates are looking at some good ideas from startups. So we see that kind of exit opportunities nowadays. Earlier they were not there, but now those opportunities are coming up. Investor ecosystem also expanded very fast. Investors are willing to put money at every stage. And early stage investors tend to get exit in subsequent stages. So that is the most, I think, preferred route of exit nowadays. Just
My question, I have two questions. First question is, generally in case of startup, along with funding, they are expecting a expert to guide them on the business, how sir was telling. As an investor, you must be having hundreds of portfolio. How do you do justice for this expectation among the startup owners?
say, as such, yeah.
Generally, we don't like founder who is too much dependent on investors because we want him to solve the problems of his life and not become a problem for us or not keep looking us at to solve these problems, right? I mean, but having said that, all the, funds, depending on the size, they have different teams. So like there is an investment team and there is an operating team. So those partners, we call it operating partners. So for example, if we are a D2C company, we'll recruit somebody who's expert in brand, marketing, and those kind of stuff. That person is entirely available for all the portfolio companies to guide them only on marketing and branding. So that way, that bandwidth is available, right? I mean, but that happens when a fund is of a particular size and a scale where they don't only have investment partners, but they have operating partners as well. And the role of those operating partners are to guide, the portfolio companies on various aspects of business and stuff. Yeah.
Other question with respect to now, as we were talking about, you were talking about uniqueness. So I have few startups which are not in unique. Some they have copied some or other ideas, but they have a capability in terms of manpower, in terms of resources, and better supply chain management. Will that be added as value added something? Managing
was
end-to-end
discussed.
supply
In
chain.
fact, that was answered by him earlier.
Say personally, I look at it as business. As a business, whether it is making sense, idea may not be unique. As Hitesh also mentioned in several cases, it may not be unique. But if as a business, if it is making sense, it is going to be profitable, it is going to be sustainable, then yes. Whether team has the capability, team has the execution skills, then it can be funded. Uniqueness is e-commerce, what is uniqueness? Now Nykaa, suppose Mama Earth. So they are selling all cosmetics, but in the execution, branding, so they have created unique proposition. So as a business, it has to be good.
Thank you.
Sir, good morning, sir. Just a second. Just on a continuing on the same
Sir.
question, there's like when you are talking about there are two players or the two portfolio companies in the same sector. So how, as a just on this side of the table, whether you are finding synergy with the same set of companies, like or internally there are certain governance issues, you are investing in one set of companies, one portfolio companies, one sector, and in the same sector there is another company. Hitesh bhai said about that there are operating partners which are helping with one kind of skill set or other kind of skill set. Is there any conflicts within the companies or it is acting as a synergy? Just wanted to get your perspective on that.
So there would be, kind of, let's say, for example, funds which will invest into similar, startups, right? I mean, which have, and those are many such, investors you will find common in similar startups. So Cars 24, Car Deco and Speedy, almost similar businesses. Go and check their investor list. Some of the investors are common across all three, or almost all, at least two of them, right? I mean, so investing into common sector or common this thing is that's fine. The only thing one has to manage is the partners are different. So investment partners are different. They cannot be the same. If they are same, then it creates a conflict in sense that sharing of information, sharing of data, all those things start, kind of cropping up. But most of the times when, the funds invest into similar set of, companies, their partners who are managing are very different. And then they follow the governance in terms of not sharing details or strategies with each other so that, it remains confidential. Otherwise, promoter will get, very uncomfortable, dealing with those kind of things. Yeah.
Just to add, normally at the VC level, we don't invest in the similar, maybe both are direct to consumer, but they may be different product categories. So business model may be same, similar either direct to customer, B2B, enterprise, but will not invest in the almost similar companies. Otherwise, there is going to be conflict of interest, especially at the VC level. At a larger level, even you're talking, but they are looking at the growth stage.
Yeah.
So at the growth stage, VC, it's a PE fund, doesn't have much value to add. So they are just putting money. They are just riding on the promoter skills to grow the company. So at that stage, their involvement and interference is relatively much less.
We'll take last question in the auditorium, because I said auditorium specifically because there are 2-3 hands raised. Hitesh bhai and Kamal ji have agreed. They can answer it offline to them. So please, last question, because he has raised the hands earlier, very early, right in the beginning.
Thank you, sir. Sir, while delivering our Kamal Bansal ji, just before taking the questions, he has told that some units may be incurring losses from 5 to 6 years. In such cases, when 2 startups are there, one startup is incurring losses for some 4 to 5 years because they not even reached the breakup, and other unit is there that about to just break up. And in such both merging cases, how you are going to look into the aspects for further financing by Hitesh bhai?
So you are talking existing portfolio companies or any company which is approaching fresh, or the existing companies?
Existing, because one is incurring losses already. 5 years loss they incurred. This is startup unit only. And another startup unit is there that is not incurred losses, but just break up. But that is also 3 to 5 years. But when those 2 units are merging and these losses are there, for the losses, how you are looking up this one for further financing, Hitesh bhai?
So it is, I think, but I think how will, which one I will
Okay.
propose
So
to
I
you
think
for fundraising?
what happens is, loss making is something which doesn't, disturb us, too much. Right? Let me tell you that, right? Amazon has a track record of kind of getting into markets, and before they become profitable, at least they spend some 13, 14 years, and they make losses, right? But whatever markets they enter, they largely become a monopoly, and they are the ones who cover the large part of the market share. So important aspect is that if there are similar 2 startups and into similar line of business, and one is making losses and other is kind of break even, I think, we will look at it is more, I mean, it's not objective, it is subjective. We'll look at, the other matrices in terms of market penetration, brand creation, team, platform, tech capabilities, right? And it is not the only metrics, which one looks for. That is a small part, or let's say, if I create a scoring card, it may have a weightage of 20-25%. But balance 70-75% are also 75% is also important, right? So it's not a apple to apple comparison, or kind of it's kind of a comparison where you have to get into the minor details of other aspects as well, right? So it's not just one criteria which you can compare and make a decision.
So I think with this, on my personal behalf, I must thank both the panelists. I know the subject has a lot of questions, and we'll have some discussions outside also, which both of them have kindly agreed. So over to you, MOC.
Thank you. Thank you very much to all the panelists for their valuable insights. Actually, we are lack of time. Investment in startup is not just about funding ideas. It is about fueling dreams and shaping the possibilities of tomorrows. And thank you very much for guiding us how to shape these dreams for tomorrow. Now to present Momento as a token of our gratitude and appreciation, I would like to invite on the stage our CCM, CA Dr. Rajkumar Adukia-ji, to present the Momento to our distinguished speakers for the day, Mr. Hitesh Sachdev, and Mr. Kamal Bansal ji. A great round of applause for him. Big applause. Thank you, everyone. Thank you, everyone, for your enthusiasm and engagement, for being present here. And I wish you all a very productive and power-packed day today.